Hi, I'm Tim Filipponi. I'm a certified public accountant here in Buffalo, New York, and this is tax tip number 3, auto expenses. Typically, there are two ways to deduct auto expenses on your tax return. One is the mileage rate method, and the other one is the actual expense method. Now, personally, I prefer the auto rate method because you're not required to keep all the documentation for all the additional expenses that were deducted on the actual method. For example, insurance, gas receipts, oil change receipts, all of those expenses would be required to be documented if you deducted the actual auto expense. Now for 2010, and the auto rate was 50 cents a mile. For 2011, the auto rate is 51 cents a mile. That's a pretty good tax deduction. Now, the only thing about the tax deduction as far as whether you can claim the standard mileage rate or not is there's certain areas that are excluded, such as if you're a fleet manager, if you're running 5 or more vehicles in a fleet. Additionally, if you're a mail delivery person in the rural setting and you're being reimbursed expenses, you can't deduct your auto mileage. Additionally, you can't deduct your auto mileage if you're using an accelerated or have been using an accelerated depreciation method on that vehicle previously. Also, you can't use Section 179 or can't have used Section 179 depreciation on that auto previously as well. Now, the deduction of the auto mileage is an employee business expense deducted on your 2106, which carries forward to your Schedule A for itemized deductions, subject to 2% of your adjusted gross income. This has been tax tip number 3, auto expenses.